We begin, though, with our talk of the tape. Just one more trading day now before the next big hurdle for stocks, the CPI, a read that could either confirm this early year rally or very well kill it. So what's really at stake? Let's ask Malcolm Ethridge, CIC Wealth Executive Vice President, here with me at our headquarters today. Welcome up. It's good to see you up from D.C. and here at our headquarters.
Yeah, I'm glad. I know you didn't think I actually owned a tie, but here I am.
All right. It's good to have you. So markets feel like a little nervous. We've got CPI now looming, right? Tuesday morning. We got one more day ahead of that. What's really at stake here now?
Yeah, I actually think sort of the opposite. I think investors are showing a little bit of over bullishness now. If you just consider what stocks have actually started to break out, we're seeing crypto make its way back. I think folks are getting a little bit over their skis with this market reaction to it, at least so far.
Well, the question is, the areas where maybe they've gotten a little over their skis, that's where you've got more nerves, I think, than other parts of the market, right? The growth trade.
That's right.
Which has obviously started the year really well, but lately looks like it's a little shaky.
I think you're even being generous calling it a growth trade. I would call it just speculation, wild speculation. And especially since you consider this week, anything big happened this week, anybody who's not currently rebranding their company to include something related to AI right now is worried that they're going to miss the growth train. And so we're getting a lot of speculation is the reason crypto is on its way back. We're getting a bunch of companies that have no business fundamentals whatsoever that are going to have this resurgence because they throw AI in there. They talk AI in their earnings, and it throws things out of whack a little bit.
I feel like, you've been pretty negative for the last many, many months, but I feel like you started to turn the corner a little bit and try and get a little more positive as the year ended, as we started now. Are you back to thinking that we're going to go back to the October lows, or where are you now?
No, I think we definitely have potential to come out of the fog that we've been in, all of 2022, basically. But I just want to caution investors to focus on companies that actually have businesses, right? The quality companies that are actually returning cash to shareholders, for example, right? Paying a dividend or doing buybacks, or maybe a mix of both, and not so much jumping right back to the more speculative names that aren't really doing any business. They're just stock tickers.
What's on your short list of best ideas right now?
So it's not going to be a surprise to anybody at this point because it's been the talk of the town all week. But Microsoft, I think, is actually on pace to become the most important company the rest of this decade. If we think about Apple's iPhone moment in 2007, I really think that that's possible for Microsoft with this whole OpenAI and ChatGPT generative AI component.
So you're able to separate what you would consider to be more speculative parts of tech and then some of the mega cap techs, because there's been a big question about those too, hasn't there?
Oh, for sure. I just said Microsoft, but they're the only mega cap tech that's positive this week, right? So earnings last week really took a lot of the mega cap tech names down, and folks started to turn away from them. And they said, I can go buy a Tesla or go buy a Facebook or something else and see significantly double-digit returns so far this year. Why would I own an Apple, or why would I own Amazon or whoever? Microsoft's the only positive one out of the gang. But I think still we can look at those names and say they really do business. They really are in the business of doing X, Y, or Z. I can't really justify why I might want to own the metaverse company at this point, even though Mark Zuckerberg used the word efficiency 50,000 times in his last public
But you
appearance.
still have to decide what the right price for that is. If these are, in your mind, more legitimate, businesses, more legitimate growth engines and cash generators, there's still a price to be paid that's right versus what was allegedly wrong last year. And that's why they corrected so much and why their valuations corrected too. The jury is still out, isn't it, in terms of whether those valuations have come in enough?
I don't know. You hear about this multiple compression that we're supposed to see before we actually turn the corner and the market starts to recover from the bear market of 2022. But I would argue that the thing that makes this situation so unique and tough to make that argument as strongly as you might in the past is the jobs market is so strong that we don't have to have this recession that everybody thinks that we have to have. We don't have to have this multiple compression that goes all the way back down to 15 that people think that we necessarily have to have this resurgence. We're probably already turning the corner here.
You really think that? So you think in terms of what, like a new economic cycle, a new bull market cycle, as some people have suggested too?
Precisely. So just statistically speaking, since 1950, right? So in recent history in the markets, The average bear market cycle lasts about 14 months. And if you think about the one outlier that was 2020 when the bear market only lasted 2 months, we're already 14 months from the November 2021 start of the bear market. That means that history is on our side. And if you also couple in there with the fact that since 1950, the same period I'm giving you, the stock market always moves 4 or 5 months on average before the economy starts to show you that things are getting better. We're already feeling some semblance of things are on the mend.
Okay, you use an interesting phrase, what's on our side, and I'm writing it down because guess what's not on our side?
Okay.
Right? The Fed.
Right.
The Fed is not on our side. And rates are moving up. I see the 10-year today at 375, we'll call it. They've already, and I wonder if that jobs report of last Friday, 1 week ago, was a bit of a near-term game changer, if it means that you're going to be dealing with a more, quote-unquote, hostile Fed longer than you thought.
But, okay, we have CPI next week, right? It'll tell us a lot. But the components that really matter and have gotten us here so far this year are starting to look good, right? If you think about energy is up slightly, sure, but food prices are down. We also have housing is on its way down. OER is actually starting to trickle down at least. Home mortgages are already declining in pricing, even though rates are up. So the components of CPI that initially got us to the part where we had to hit the panic button are working in our favor. They're just working really slowly. So the rate cuts are working, and I don't think that Powell necessarily is going to tell us anything that we weren't expecting already. He's been really good about telegraphing where they're going, and I don't see any reason for them to differ from that course.
We've learned over the last week or so that 10 days really that his voice is seemingly the only one that matters, even though you get an awful lot of Fed speak, including as we speak. Philly Fed, Patrick Harker, quote, surprisingly strong jobs data did not alter his view that moving to smaller interest rate rises is a good strategy for the U.S. Flagged the prospect of rate cuts in 24 should inflation continue to ease. Remember, it was Clarida earlier in the week. I mean, you had this huge event with Disney and Peltz, which was such a marquee event. Let's not forget that there was another big event, and that was Clarida on the network with Sarah earlier in the week, suggesting that you could cut interest rates this year.
So that's the part I'm hesitant about. I understand that, we buy tomorrow's earnings today as investors, but I'm hesitant to fall into the trap that we expect cuts either at the end of this year or early next year, because I will say to Jerome Powell's credit, he is on this quest to prove that he's more Volcker than Burns. And so he very clearly doesn't want history to repeat itself and have the backlash that goes along with saying he made it too accommodative too early. And so I think it's unlikely that we see that cut that folks are expecting, but I do think that the pause happens a lot sooner than maybe some bearish folks are thinking.
But you can have the kind of market view that you do without a rate cut in calendar year 2023?
I don't think that we necessarily have to have a rate cut. I think we just have to have some clarity on whether we're going to get any more increases in the back half of the year. I think that is going to do a lot of the heavy lifting for the market.
All right, let's expand our conversation now. Bring in Kristen Bitterly of Citi Global Wealth and Kara Murphy of Kestra Investment Management. It's great to have both of you with us today. Kristen, I begin with you. Just look ahead to Tuesday. Does this early year rally that surprised a lot of people, does it come down to that print on Tuesday morning?
Does it come down to that print? That's an excellent question. Look, I don't think that the rally that everyone was applauding year to date really has strong legs, because when you look at the composition of that rally, what was really driving it? So you had some of the most heavily shorted stocks from last year, up over 60% this year. And when you really break it down, there's only 10 names that were driving about 50% of that rally in U.S. equities. So we were still playing defense at the beginning of this year. And I think the most interesting thing is when you look at these types of events and going into them, you don't need to either be all in or all out. A balanced portfolio in the month of January actually delivered mid to high single digit returns depending upon your allocation. So you don't need to chase some of those returns that we saw from tech to still have some exposure and to actually still be defensively positioned going into events like Tuesday.
I mean, to your point, Kristen, the 60-40 portfolio off to its best start since 1991 in terms of what you would consider to be the classic balanced portfolio. But at some point, it is going to be right to start playing some offense, as Malcolm was suggesting is going to be approaching soon. But what is that moment? What triggers it?
I think that moment, Scott, so you said it earlier, we are not fighting the Fed. And so the Fed is still continuing on this path. And I think one of the things that we have to keep in mind is regardless of whether we get another hike, maybe two more hikes, we're still at much tighter financial conditions than we were a year ago. The cost of capital is substantially higher. So looking at the rate hikes alone, we have 450 basis points. But the Fed has also taken out about $500 billion out of the bond market, taken liquidity out of the market as well. And so when you add all of that up, it is harder to make money in these markets. And so while Q4 earnings were better than feared or better than expected, the one thing that I was paying a lot of attention to is it's all about expense management. So there wasn't a lot of discussion when you really look at the individual companies about the ability to grow top line revenues. It was more about expense cuts, expense management, which that has us cautious because that medicine is flowing through into the economy and is flowing through into corporate earnings.
So, Kara, what's your take, given what you've heard so far from our panel?
So we think that the inflation story is largely over. And that doesn't mean that the Fed's job is all done, but clearly the medicine of higher interest rates is working to bring down inflation. Commodities are down. We have number of months of decelerating consumer prices. Inflation expectations are down. Yes, jobs and wage data still look fairly strong. So that tells us the Fed is not done. There is some risk there of continuing interest rate hikes. But the bigger question is the lagged impact of all that tighter monetary policy flowing into the economy. There is a side effect to all of that medicine that the Fed has given the economy. That is, final demand has to come down and corporate earnings have to come down. Now, some of that is starting to happen, which is healthy for the market. If you go back to the summer of last year, folks were expecting corporate earnings to go up 10% in 2023. By the end of 2022, those expectations had moderated to 5%. Today, they're at 3% growth for this year. So some of those expectations are starting to come down. But ironically, it's happened at a time when the S&P has rallied. And as some of the other guests here today have said, you had a reversal of factors where last year you had more defensive names, more high quality names that were doing well. And then all of a sudden in the last couple of weeks, we've had the lower quality names that are really rallying. That tells us there's a little bit of too much excitement in the market right here, but we're at least doing some of the work to have more realistic expectations for 2023.
Malcolm, I'm reminded just yesterday, if not day before, so Jamie Dimon reiterating can't declare victory yet on inflation, right? Fed could go above 5%, could hold it for a while. Premature to think that this fight is anywhere close to over, and maybe people are underestimating that, despite the fact that the Fed appears to be near the end of its road. What do you think?
I don't know. Jamie Dimon's the same guy that one day was telling us that bank balances were the strongest they had ever been, and the consumer's never been so healthy. They've never seen this many deposits on record. And then a week later telling us a tsunami was coming and everybody, hunkered down. And so I think, we're looking for the extremes when we probably should be working with a little bit of nuance.
But is that so much of an extreme to suggest that why should we declare victory yet?
Well, I don't know that we necessarily...
Because of a couple of prints going in our direction?
I don't know that we necessarily should declare victory. I think that's a fair way to put it. But as Kara was just saying, I think the narrative around inflation is less biting as it probably needs to be going forward. I think we all know about the impact of inflation. We all know the work the Fed is doing to fight inflation and bring it down. And I think it's probably going to be in our rear view mirror here pretty soon. And so we as investors have to start looking forward to what happens next, right? So the inflation narrative starts to fade away. And then what? What do we start to focus on then?
Kristen, as somebody suggested in the prior hour at the very top of the show, the market has never bottomed in history when the Fed is in the midst of a hiking campaign, which it still is. But yet we seem to be a little bit quick to think we're about to take the next step forward.
Yeah, so the equity market has never bottomed before a recession has officially begun. So if you're in the camp that you believe that all of this tightening could indeed lead to a recession, then there's more downside to come from here. I think what we're watching really closely to just kind of pull this together, the Fed has a pretty straightforward mandate in terms of price stability and full employment. And so depending upon which one they're more focused on, that's going to drive their trajectory. Right now, it's around inflation and looking at those cumulative actions, as we've said. But once we start to see some breaks in employment, and let me give give you an area where we could see that. So residential construction, when we look at the impact on the housing market that happened last year, we saw a decline 30%, 40%, both in terms of new home sales as well as existing home sales. That has not flowed through into new home construction. And so naturally, those housing starts are going to come down, and they've started to come down in a more material way. When you look at the employment that could be impacted, that's 200, 300, 400,000 jobs. And those are the types of data points that we're looking at when the Fed is going to have to start paying attention to the employment backdrop versus the inflation backdrop.
Kara, you know, when Malcolm looks at what's happened in the market to start the year, and let's focus in on tech, because I think it's the most controversial place to look right now, just given where it was last year and what it's already done. This year, he makes the distinction between so-called speculative tech and, my own word, legitimate tech, right? The Microsofts and the Alphabets, Apples, Meta, et cetera. Do you view those trades differently or similar in the way that tech has started this year?
I do have a similar view. You know, if you go back to 2000 during the bursting of the tech bubble, there was the new economy, old economy. And within tech, we sort of have the new tech and the old tech. There's some areas of tech, like Microsoft is a great example, where you have companies with really proven business models, very diversified different sources and products, and really strong cash flows. And then you have a lot of other sort of areas within tech, and I think crypto is another great example there, that are sort of going on fumes. You know, they're not earning money, their business models aren't nearly as proven, and we've seen those that have really caught a bid more recently, and that's where I start to sort of question the quality of this rally.
Malcolm, I'll leave the last word to you. The other great debate right now as to whether the U.S. is even the best place to be putting your money. International markets are in favor from a lot of different corners. What about yours?
I think that's a fair question and a fair argument, but I would just point to the fact that at least a third of the S&P companies that are based in the United States do business internationally anyway. And so you'd still get to benefit from a company like, again, to keep using the example, a Microsoft or an Apple or Alphabet, somebody like that, who's got tons of international exposure that's well diversified that way without having to go all the way toward finding out what's the right international company to be invested in. So, you know, you could add that to your portfolio if you're an investor that wants to make sure you've got that fully diversified basket of ETFs or what have you. But even having exposure to the top third of the S&P would get you significant enough international exposure.
All right. That's going to be our last word. Good weekend to you. Thank you for being here. Ladies, to you as well. Kristen and Kara, I know we'll see you soon.